Mortgage rate is your rate times loan times term. So what causes your rate? Rates are usually a little bit higher on 30s, a little bit lower on 20, and a little lowest on 15, then a little bit lower on 10. Now your rate is going to be determined by your credit score. The better your credit, the better your interest rate. Here's the funny kind of, you think this is dumb. The guy that has the least amount of credit, bad credit, everything, gets the highest interest rate. They usually can't afford it. It's kind of weird, but the better you take care of your credit, the better interest rate you get. The better interest rate you get, the more house you can buy per dollar.
How can the rate impact your loan?
Okay, your interest rate is going to determine, if you have a higher interest rate, you won't be able to borrow as much money because the rate's going to make your house payment higher. Again, that DTI ratio is going to get a little bit higher. So obviously you want to keep your rate, the lower the rate, the more money you can borrow per dollar.
How does the overall economy impact rates?
Well, right now we're dealing with the high inflation in Texas, right? You probably all, granted, we're in March of 2022. Inflation is high. Interest rates are over 1.25 points, 1.5 points up since December. So in other words, people's rates have gone up probably, I'd say 45% higher today than they would have bought a house in December. So how does the economy do with rates? Economy changes interest rates a lot. Right now we're in a high inflation economy, higher interest rates, less house for per dollar. So the economy does affect interest rates. Like the Fed's raising a rate. Fed really does not have anything to do with mortgage rates. That's the Fed's money loaned to banks, overnight money. However, that kind of trickles down to the mortgage world. Again, this is Chuck Weaver. If you got any questions about any type of a mortgage, pick up the phone, call Chuck Weaver, or go to chuckweavermortgage.com.